Being a trader means knowing how to analyze a trading chart and using technical analysis to make buy or sell decisions. As you can see on your chart, you can find all sorts of information thanks to candlesticks. You can spot trends, and you can identify signals to buy or sell. You can also draw price zones. We'll be able to do all sorts of things in terms of technical analysis, which will then allow us to buy or sell a market. Secondly, we'll combine technical analysis with economic fundamental analysis. Relevant and important information, economic figures like inflation, interest rates, decisions from the Fed, unemployment rates in major countries, and a whole range of economic stats will help you add weight to your technical analysis. And in this way, you'll have everything you need to make purchases or sales on the financial markets. When you're a beginner trader, it's easy to get lost with all the information out there, the number of trading strategies that exist, the number of trading indicators, the amount of economic stats and figures, learning how to analyze a chart, learning how to manage your risk in the financial markets. Well, that's a lot, a whole lot of things and skills to master for someone who's just starting out as a trader. So, in this video, I'm giving you a simple plan, not going deep into the details, but you'll have a roadmap to follow and the most important information to keep an eye on. So, first of all, the simplest and most profitable way to trade for a beginner, and even for an experienced trader, is going to be trend following. When we notice that a market is starting to trend on a chart, well, we try to follow that trend and take advantage of it to make some money. Why do we follow the trend? Because when a trend kicks off, like you see here, it means there's a lot of money involved. It means the big players, plain and simple, are making moves to buy, and you can't go against the big players. You have small amounts of capital, for sure, you're not a billionaire, so you're not the one deciding the direction of the financial market. We, as independent traders, are going to follow what the big players are doing, and we'll simply try to buy the dips during this upward trend. Now, obviously, it seems simple because the moves have already happened, but in real time, I assure you that with technical analysis, you have ways to anticipate what's going to happen. By the way, subscribe to the YouTube channel. I just created it. I'm going to post about one video a day, or one every 2 days. I'm not selling any products. I'm just passionate about trading and I want to share that passion with as many people as possible. So I'll teach you how to spot the best price zones, well, to buy and follow the trend in this specific case, for example. You can then see that we have a trend, and we also have price zones that will form, the market's support and resistance zones. And it's especially on these price zones, here in yellow, that we're going to try to look for buying opportunities. The market always moves from one zone to another. That's why we're going to avoid trading in areas where there aren't strong price zones that can make the stock prices react. Let's focus on this price zone, because this upward movement is the breakout move of the resistance. As you can see, it happened violently and it was the signal that triggered the bullish trend I just showed you on the daily time frame. And as you can see, once the resistance was broken here, the market then came back to retest it, using it as support for a while. The market goes back and forth, the price drops, the price rises. And what we're going to wait for is a strong bullish signal from the price to finally enter the trend at that point. Here, we don't enter the trend because we're not fortune tellers. We let the market make its breakout move and give its bullish signal. And then, we're going to enter patiently and intelligently, waiting for a good price at the support with a perfect signal. Here, you have two ways to buy on the 4-hour chart. The first is to buy at the close of this candle here. Why? Because you see, the market came down to test the support. It was rejected upwards at that point with the 4-hour candle. Next, you have an indecision candle here. And finally, you have a somewhat impulsive candle here. This candlestick simply tells us that the support has been preserved, that buyers are present, and that we're heading back toward the top of the mini range that is formed here. And so, we can set an entry price at the close of the 4-hour candle, place a stop loss below the 4-hour candle here, and let the market do its thing. The second possibility, which is a bit safer, is to wait for the breakout here of the previous high of this small resistance. And as you can see, at the close of this candle here, it's the same thing. You can enter a buy position because the market is showing strength. It makes a new high, the price is very bullish, and you can enter with a stop loss below the candle and let the market do its thing. You have yet a third example. As you can see, the move has happened and the market is going to be stepped below this yellow price zone for a while. The price will drop down to the previous resistance here, which, remember, was the resistance that was blocking here. So the market does a pullback on the resistance. When that happens, you need to watch for a bullish buy signal on, well, the price zone. You can see it here. We have a perfect signal. We have a 2J in the zone here, followed by a bullish engulfing pattern. It's beautiful. We break out of the support zone here, and then the market goes up. It will come back to retest one last time and finally return to the top of the range, right there. So, trend following, we could spend hours going through examples. And as you can see, the mechanics are pretty simple to understand. Finally, what's important to do when you've bought or sold a financial market is to secure your risk as much as possible. Protect your capital. Don't risk more than 2% of your trading capital per stop loss. Aim for a favorable risk-reward ratio, at least 2 to 1. That means if you're willing to lose $50 on your stop loss, you should be aiming to make at least $100. Obviously, the higher the risk-reward ratio, the better. In any case, don't burn yourself out, don't get discouraged, stay focused, keep working, keep practicing, and the results will come little by little.